So, wir haben heute einen ganz besonderen Gast, erstmals bei mir auf dem Kanal, Julian Brigden von Macro Intelligence, two partners. Julian, how are you?
I am very good, thank you. Thank you very much indeed for having me on the show.
Und das Schöne ist, dass man merkt, dass wenn man in Reutlingen studiert hat, dass man es an der Wall Street sehr weit schafft, nicht wahr, Julian? Ja?
Yes, it's been a very long, and as we were discussing earlier, we're both quite long in the tooth now, as we say, and we've done various different jobs as we've moved ourselves around the world. So yes, it's a long way from Reutlingen via London back to New York, and now I live in Vail, Colorado.
So, come on, you got to give us a few German words here, right? You can't just, you started in Reutlingen, Betriebswirtschaft, der Mann hat Betriebswirtschaft in Reutlingen studiert, right? Jetzt ist er in Colorado, ja?
Yeah, but it's like 30 odd years ago now, that's the problem, Marcus, so...
Am I going to get a word out of you?
Ja. Ich begrüße alle und ich hoffe, dass Sie finden, was wir heute diskutieren, sehr interessant.
Also man merkt, ich werde jetzt ab und an auch bei dem, was jetzt kommt, ein bisschen übersetzen und Hilfestellung leisten. Im Zweifel wird Julian das für uns auch machen können. Ne? Und vielleicht ein, zwei Worte noch zu ihm. Für mich ist Julian ein ganz besonderer Gast, weil ich ihn tatsächlich schon seit vielen Jahren mittlerweile verfolge. Ich bin durch RealVision auf ihn aufmerksam geworden. RealVision, ein wunderbarer Kanal zum Thema, wenn man wirklich tief eintauchen möchte in die Welt der Finanzen. Und vor allen Dingen auch einen sehr ähnlichen Ansatz, den ich hier in New York in meinem Studio verfolge, nämlich diese Notwendigkeit, wirklich professionelles Research und Input, das man an der Wall Street bekommt, auf dem gleichen Niveau auch an Privatanleger weiterzugeben und dadurch quasi ein Gespräch zustande zu kriegen. Julian, you have quite a career behind you, just like I do. Yes, we're both a little older on the tooth. We look fantastic, of course. Yeah.
Oh, thank you very much. But yes, you do. You look gorgeous, Marcus.
You look gorgeous. Schatzi, I'm already married, yeah, but it's like, and but I have to tell you, Vail, Colorado it beats New Jersey, I can tell you that, right?
Yeah, no kidding. And I was in New Jersey for a long time, and I have to say, yeah, Colorado does definitely beat New Jersey.
Yes, you do know that after this stream, I will potentially come and visit you. So, depending,
That's
of
awesome,
course,
mate, yep.
of course, how this whole discussion goes. Wir werden natürlich auch hier im Laufe des Streams wieder fleißig Fragen von euch mit einbinden. Ich möchte euch bitten, die Fragen vor allen Dingen über YouTube zu stellen. Da ist die Einbindung etwas leichter. Ich will mal ganz kurz mal schauen, ob ich hier noch Facebook mit einschalten kann. Nein, also am besten ist es, ihr stellt die Fragen auf YouTube in dem Livestream und natürlich wird das Gespräch, das jetzt stattfindet, auch anschließend noch als Podcast laufen am Freitag. So we have a lot to talk about and I think, Julian, one of the key issues is this wild question about inflation. Is it transitory? Is it not transitory? If you look at inflation expectations, the Federal Reserve seems to believe that this whole thing will be transitory. But let's go back to the inflation numbers. So we had very hot CPI and PPI numbers in April, very hot numbers. But since these numbers were released, the bond yields actually didn't go up, they actually decreased. Why?
So I think, look, we've been, actually, the first trade we put on, or recommended clients put on at the lows of last spring, was on the 24th of March, and we recommended that people buy 5-year break-even inflation for a hedge. And I know that's quite a complicated sort of professional trade. You can, I think, do it over some ETFs increasingly these days. But the reason is that in part inflation is simply cyclical. It tends to follow the cycle. Now, I think what we've ended up with is something significantly worse than just a cyclical rebound in inflation. But it was a great trade. We also wrote at the beginning of this year, the first report of this year was that inflation would be the singularly most important variable for 2021, both in terms of markets and how policymakers and markets reacted to it. So when we look at it, Marcus, and we look at our models, we think there's probably another 1 to 2 pushes to come in inflation. I think it would not surprise us to see a headline rate that is pretty close or even above 6% CPI when we peak. For you guys sort of trying to follow it, I would encourage you to look at things like the PMI prices paid indicators. Those have generally, whether you look at the ISM or some of the regional stuff in the US, those have generally been leading. And they also work in Europe really, really well. I think people forget that, you know, you don't always have to have the bond market being led by the US. You can be led by the Bund market, you can be led by JGB market, be led by, you know, gilts, because these are very connected, interconnected markets. But that said, we are coming to a cyclical peak in the headline push. So then the debate will go to this transitory, not transitory issue. And I think when you look at that, there'll be a window where the policymakers will look like they are right, because we won't sit at 6. We will tick down to 5 to 4. Most of our work, though, is suggesting at that point, at least for an extended period of time, and I think one has to be careful here. There's transitory from a policymaker's perspective, and there's transitory from a market's perspective. So,
Julian, do me a favor, because I want to work through each single step. And so, going back to the original question, you know, the CPI numbers were very hot, the PPI numbers were very hot, the bond yields actually went down. Why did they go down?
So they went down, I think, for a couple of reasons, Marcus. The first thing is, and we had said this to clients, we'd had this long break-even position, we got out of this long break-even position, and we actually positioned shorter in the short end of the curve looking for rate moves, and those haven't started to pan out yet. But we got to the second most oversold conditions in the US bond market in 40 years.
So basically everybody and their neighbor had a short position on Treasuries. Also im Prinzip haben jeder unser Nachbar hat darauf gesetzt, dass die Renditen steigen würden, waren short of Treasuries.
Yeah, exactly. And you can recreate the chart that we were looking at. Now, I prefer to use futures and not yields, because obviously you get disproportionate moves in yields as you get lower and lower in percentage terms. But you can recreate it and just look at a weekly RSI, and you will see that we got massively short, essentially, of fixed income. If you look at the markets and you look at, say, 2016, we got to sort of similar levels and 2013 after the taper tantrum. But then you go back and you look further in time and you look at two of the major bear markets in fixed income that we've seen, 87 and 94. And even in both of those, very sharp initial sell-off, then a kind of period of sideways tracking where you work off that oversoldness in the bond market. And that's kind of the model that we're thinking. We're not yet at levels, we're getting close, where you would think about initiating another major short at the long end of the bond market. And as I said, if you get this peaking of CPI, at least on the headline rate, I think that's going to give a window where the policymakers are going to go, I told you so, right? This is just transitory. I think the second thing is that stopped some of the sell-off is we've run down the Treasury General Account. So essentially this is kind of QE. That's helped remove or balance some of the issuance versus the QE buying program, so you've had to put less pressure on the market in terms of supply. But that also starts to abate as you move into the second half of the year and through the summer. So our window, as I said, is we've been toying with the long end of the bond market, but really just to have something in it. so that we watch it. We've had a bigger position in the bond market. We've had a bigger position in short sterling, and we've had a bigger position in the sort of 2023 euro dollar. So in other words, a bet on interest rate movements. And we've not really been playing around much with that long end for the moment, because we need to work off those oversold conditions.
Yeah, it's interesting. It's interesting you say that, because I think if you look at the year 2021, you had this phase where it was very obvious that you would have to get a huge pop in the bond yields, and then it started tapering off. But what you're basically saying is that after this phase of consolidation and rundown of rates, that we are going to turn higher at a certain trigger point in the second half of this year.
That's pretty much our base case. Yes, I mean, I think you need certain things to fall into place, and we could be wrong. And the most obvious ways that we would be wrong would be if the Fed found a backbone, right, and suddenly decided that they were going to be a real central bank, and not this sort of woke adjunct of social policy of the Biden administration. And secondly, if, say, the Biden administration failed to deliver any further fiscal stimulus and we hit some sort of fiscal cliff, but neither of those seem to be the base case.
It is interesting to see, however, how the Federal Reserve is starting to change its tune quite a bit, right? I mean, look at Vice Chairman Clarida about a week ago, stating that there's no need to talk about tapering at this point. 7 days later, now it's like, well, we ought to talk about it at some point at some of one of the next FOMC meetings, which it's phrased very smartly because nobody still knows what meeting is he actually talking about. But we have the Fed meeting coming up on June 16. Do you think that Powell is going to echo those words?
I think, we've been saying this to clients. This administration in broad terms, so Fed, White House, et cetera, has this truly visceral objective now of trying to address inequality, right? I mean, you really mustn't underestimate this. And the Fed went through a lot of navel gazing sort of back in 2016. It started coming out of the Midwest Federal Reserves, where they, and I laugh about this, Marcus, because you and I would just sit there and go, duh, to use that. No,
I don't, Julian, I don't sit there, duh. I sit there and very often think, what the fuck?
Right, exactly. I didn't want to go there. I have this reputation for swearing a lot, so I was trying to keep it professional. But we've sat here since the launch of sort of QE and go, well, balance sheet. Look, you're German and you've learnt the lessons of the Weimar Republic, and people forget that in the Weimar Republic, as you debased the currency, the equity market went up, right? Many thousands of percent a day, because it's denominated. It's a claim on a hard asset in many cases, and you were just reducing the value of the denominator. So, in that case, the Reichsmark, right? So, why wouldn't equities go up? So we've been sitting here and saying, look, take the balance sheet. I remember at QE2, the launch of QE2, I took a straight line extrapolation of what they were telling you they were going to do with the balance sheet, put the S&P over it, worked out how much every 100 billion unit of QE was worth in S&P points. And when they stopped QE2, I was 25 points away from the actual level. So, I mean, this is mechanics. This is not, science. So they did all this sort of navel gazing. They came to the conclusion that, oh my goodness, we have added to inequality. No shit, Sherlock, right? And so essentially now they're trying to address that.
But I mean, isn't it?
So
but Julian, taking the comments from Druckenmiller into account, right? One of the great hedge fund managers in the United States, who I think rightfully so criticized the Federal Reserve for actually creating inequality by not raising rates and letting inflation run hot, that they're doing something quite irresponsible, which Powell, of course, rebuffed. What's your take on that?
I genuinely think they're trapped. I think they have committed to this new, as we said, wokeness, right? This social bleeding heart. You know, I mean, look, it's laudable that you want to try, and don't get me wrong, I'm not trying to be some ultra hard capitalist by any stretch of the imagination. Remember, even if I live in the United States, I'd probably classify myself as a UK Tory, which means that I believe old style. So I sort of believe in universal education, universal healthcare. I've lived in Germany, I've lived in Switzerland, I lived in the UK. All of those things, the US system just doesn't make sense, right?
Julian, be careful what you say. You might get kicked out of Colorado, okay? But
Colorado, yeah, I may get kicked out. Yeah. I don't have a gun license, you know, all of these things, right? You know, I wear metrosexual clothing, right? You know, I'm really not, you know.
Very weird for the United States.
Yeah, very weird. I don't have a lumberjack shirt, that sort of shit. Right, so, I mean, I think they're trapped because I think they've committed, as I said, to this policy. This policy naturally comes with a downside. It comes with this need to hold markets in because markets, you know, I think people forget it's not just the Fed that controls the bond market. They control one little element at the very front end of the curve. They have to control this, the longer end of the curve and balance the equity market and so on and so forth. And yet they've got an administration which is driving a very stimulative policy. And I think, yes, fiscal spending is going to slow down, but I was going through the models this morning. I mean, this is an economy now which well into the middle of next year is going to be firing on all cylinders, irrespective of what the government starts to do in fiscal spending. I mean, if they were to raise taxes massively, they ain't going to do that, Marcus, right? We're going to get probably $1 trillion infrastructure spending bill, which is less than the $6 trillion that's being bandied around. I mean, that's just politics. But this is true infrastructure, and there's no tax increases coming with this one, right? None, right? None.
I agree, yeah.
The second one that they do later in the year or early next year will come with tax increases. But once again, it's just going to be keeping this game going so that you win the midterms in 2022. So what is the Fed supposed to do in this environment? So to go back to this, what's Clarida really saying? I know, you know, it's a German audience or predominantly a German-speaking audience. You're not big rugby players, but in rugby, when you play rugby, there's a dummy, right? So you're running with the ball, right? And you remember you have to pass the ball backwards in rugby, right? So you're running with the ball and you've got all these guys bearing down on you and you're thinking, you know, there's thousands of pounds of muscle just about to hit me. And you do a dummy. So you pretend to throw the ball one way and then you throw it the other. And I think that's precisely where the Fed is, that they're trying to hold the bond market in. So they'll throw platitudes at the bond market. Of course we'd never let inflation get out of control. Of course we're ready to taper, right? And all the time going, keep running this bugger hot, right? Keep it running it hot. You know, and then you hold in the bond market, and the bond market doesn't have a taper tantrum on you, right? But even if you look, and don't get me wrong, I think they're prepping to move to tapering. When is that going to be? They'll talk about it at Jackson Hole. Mm-hmm. When are they thinking about doing it? Q1 of next year? Maybe if things go really strongly Q4. But they're talking about a move, Marcus, that is supposed to be so gradual that we're not even supposed to notice it. Right? And this is talking about, remember, tapering isn't QT. Tapering is reducing the amount of QE. So you're still stimulating, but you're just not going at 90 miles an hour like you are hacking down the Autobahn. You may be going at a more begrenzt 70, right?
Yeah. Well, I think that's a really important point, right? I mean, even the Federal Reserve of New York states that, you know, the balance sheet should keep on expanding all the way up to $9 trillion. So there will be, you know, they're still going to stimulate. But you know, I think it's interesting if you look at the timing of the how the Federal Reserve is changing the tune, right? It feels to me that the expectations of the marketplace and the Federal Reserve policy messaging started diverting. And it felt to me about 2 weeks ago when the CPI numbers came out that the market is now in a position of saying, like, look, you know, the more the merrier, it has its limits. Just give us a signal that you actually are considering talking about it. And let's say you taper maybe November, December. Maybe start talking about it at the FOMC meeting in June. And the market will be fine, because by the end of the day, you know, they're still very aggressive. And worst case, they announce a taper and at the same time an operation twist to hold the long bond yield low anyway.
Right.
So I mean,
Right.
and looking at the stock market, doesn't that all still sounds quite bullish?
Look, I'm not a bear. I'm not a bear on equities. I mean, we've been bullish on risk since March of last year. I mean, we played it in different things. When I look at the equity market in aggregate, you're absolutely right. Look, you know, loose fiscal, loose monetary, which is what we're basically going. I mean, we couldn't have looser fiscal if we bloody tried, right? I mean, 16% of GDP. I mean, all right, it's come down from 18, but I mean, this is still, we're talking about deficit spending that's going to keep running for the next 4 to 5 years, right? It's not going away, Marcus. Loose monetary, in other words, low real rates. I mean, at the moment, you know, if you take 10-year yields and CPI, we're at -2.5%, right? And
which is pretty insane, no? I mean,
which is insane.
It's absolutely
right?
insane. And also wir haben einen negativen Realzins von über 2,5% im Minus. Ja? Und Julian, let me throw right in here a graphic just published by the New York Federal Reserve. Wir haben ja 12 regionale Notenbanken in den USA. Die Notenbank von New York ist eine sehr wichtige. Die hat auch damals in der Finanzkrise maßgeblich zur Beruhigung beigetragen. Und hier sehen wir, dass basierend auf dieser aktuellen Umfrage das größte Risiko ist, das zweitgrößte Risiko nach einer neuen Variante des Covid-Virus, ein scharfer Anstieg der Realzinsen, die aktuell sehr stark negativ sind. Explain to us, Julian, because not everybody might understand what causes negative real rates and why, for example, is specifically the tech sector so affected by that?
So, I mean, real rates are really a function of the differential between, I mean, in this case, the differential, or the one we use, the differential between 10-year yields and inflation. And typically you wouldn't see this. I mean, it is a function of really financial repression. I mean, this is financial repression writ large. This is how you really destroy value for bondholders. It's not, you know, messing about like the ECB has with, you know, negative 50 basis points at the front end of the curve. It's this consistent negative yield in the long end. And, you know, there are various things that have led to that. I mean, low global yields everywhere, which attracts money into the US, which keeps the curve suppressed. Obviously, central bank QE and the Fed, you know, has been very aggressive between that and the rundown of the Treasury General Account, suppressing yields for the last 6 months, even as the inflation prints have ticked up. And we've seen a move in bond yields. It's just that they can't move far enough, Marcus. And then it comes back to this kind of interaction that we get with other markets, right? And I think, you know, you can look at treasuries and go, and, you know, any objective person would go, not touching this thing, you know, to use the British expression, with a barge pole, right, with a 10-foot barge pole. I'm not going to invest my money in these things with these negative yielding yields. But other people do, and you go, well, they should be an awful lot higher. But the problem is, which leads to the second part of your question, why can't they go higher? Well, as I said, there's central bank meddling, low global yields, and then there's this interaction with other markets. Because you get to these points and you can feel it and you can see it if you've been in markets long enough, where you know that you go, oh, well, look, treasury yields are too low, they move up, and they just did that, and we played that. And then you get to this point where they start to try and move up a little bit, and all of a sudden the equity market wobbles, right? Or the dollar goes up, and that causes other things to wobble. So you get to this sort of tension point, and you go, okay, that's the bite point. And remember, in the old days when we used to drive cars with clutches, you know, you're on a hill, right? You're balancing that clutch and the accelerator, right? And you know, and you're just trying to hold the car steady. So you get to one of those points. The issue in the US, and this is, I think, is a fundamental problem going forward, and it goes back to this thing I said, that the Fed's painted themselves in a corner. They've painted themselves in a corner with policymakers, that they've committed to support this fiscal spending, and that means underwriting the bond market. But they've also painted themselves in a corner with the equity market, and to some extent the dollar, and we refer to this as the Impossible Trinity. So the Impossible Trinity typically refers to a currency peg, and if you are, say, the Hong Kong Monetary Authority and you've got a currency peg, you have three variables that you could peg you can peg money supply, the exchange rate, and interest rates, right? But you can only control 2 of the 3. You can't control all 3. So in the case of the HKMA, they control interest rates and they control the peg. And so as a result, the Hong Kong, all the pressure around that peg is felt in money supply, and Hong Kong money supply wangs around. In the case of the Fed, they've got sort of 3 market variables. They've got equities, they've got bond yields, and they've got the dollar. And the problem that they've got is that the equity market is now extraordinarily high, particularly in the US, because post-COVID, we had this enormous run-up in these tech growth momentum names that would naturally do well and fare well in a pandemic kind of environment, work from home environment, and we push these things up to extraordinary levels. But the problem is their weightings in the overall indexes are extraordinarily high, far higher than most other parts of the world. So now you've got this issue that we now have this bear steepener in the bond market, so the long end sells off relative to the short end, and that's a recovery trade. And that tends to weigh on these tech names because really grow. They're called duration stocks. We call them Ersatz treasuries, right, to use the German. And that merely means that they grow when nothing else is growing. And in the old days, you know, when nothing else is growing, you'd buy bonds. But we didn't during COVID. We bought growth momentum stocks. And so the weighting of these things got pushed very, very high. That meant that the US equity market outperformed its peers yet again. But now you have this vulnerability as the economy reopens, and I think it's going to become even greater as the rest of the world starts to reopen. And so how do you manage this? So if the Fed loses control of the long end, this part of the sector will suffer. If the Fed turns out to be, to use the expression that's used in the sense of the Bank of England, the unreliable boyfriend. So in other words, it says it's going to do one thing. We're never raising rates, chaps. Honestly, we're never raising. Oh, sorry, look at the data. You know, we're raising rates. Then also these things will suffer. And so I'm an equity bull, but I'm not an equity bull in the US market. All our bets have been placed outside the US. So we've been long. So we've been long the MIB, the Nikkei, the FTSE, Mexico. We played EWW since like April of last year. We're now looking at perhaps getting more into EM, but it goes back to this fundamental issue, Marcus. If we have a recovery in the United States and we look at that choke point, that interaction between all the variables, so between the financial markets, the real economy, interest rates, the equity market, and the dollar, we do not believe that you can sustain US equities at this level, sustain activity, particularly in very rate-sensitive sectors of the economy like housing, with a sharp move higher in rates. So at some point, the Fed is going to have to look at those 3 variables.
And it's going to be the dollar that they're going to
equity market,
and the dollar is going to go kaboom.
Kaboom. And our work suggests, and this is actually interesting, and we've written about this, the best historical analogy is actually the late 1960s. Right? It's not perfect because we had a pegged exchange rate, Bretton Woods, but we also had a situation that wasn't radically different, and we've been trying to play this analogy since 2016, since Trump came in. If you look at the early 60s, super stable, very, very low inflation environment, really averaging between like 1 and 1.5 for a 5-year period. Fantastic returns in the equity market, as you'd imagine, great returns in the bond market, positive carry, et cetera, et cetera. Then you get to the mid-60s, and Kennedy is assassinated. You get Johnson comes in, he wins both houses, he pushes through very aggressive tax cuts, and he moves to this social policy of the Great Society. And it all kind of kicks off, right? And inflation goes very quickly, breaks out, goes from 1.5 to sort of 3.6. The Fed comes in and hits it. inflation drops, they panic because they get an equity correction and a housing correction, and they give all those rate hikes and all that tightening back, and they ease into ongoing fiscal spending. We think the analogy looks very similar to kind of Trump coming in, unnecessary pro-cyclical stimulus at the wrong point of the cycle, inflation breaks out, the Fed, as we know, in 2018, hits it, panics in early 19. COVID comes in, but COVID, and it complicates the picture, kind of gets us to the same situation, this ongoing fiscal deficit funding spending. Now, what the Fed should have done in the late 60s, when they saw this, and you can go and look at the minutes, and they were every 2 weeks, so there's a hell of a lot of minutes, right? But the basic thrust is they're looking at an economy which they think they can run it a little bit hot, but they're getting worried, and they can push unemployment down to 4%. But they're getting worried by the flows in the capital account and the gold flows, which is how they stabilize the dollar in the Bretton Woods exchange rate mechanism. And all these flows are going out because the US is overheating and sucking in imports. And what they should have done is they should have raised rates, and they should have sacrificed the equity market, aka the kind of the real economy, if you want, and pushed back against government. Right? They should have said, sorry, you're overheating this because you're fighting the Vietnam War, think COVID war, right? You've done this pro-cyclical social policy, think the American Act, you know, Social Act, whatever, Infrastructure Act. Screw you, we're the independent central bank, stop, right? A classic Bundesbank-esque Tietmeyer, you know, thing.
Of course,
they didn't, Marcus.
And of course, we have a very different scenario, right? I mean, if you look at the Biden administration, I think there's also a huge difference between, you know, Daddy, I want a Ferrari, but you're going to get a bicycle, right? Because we can't afford more than, you know, there's only a very slight majority, and I think we have the midterm elections next year coming up. It's a bit of a play. I guess the Federal Reserve is also politically stuck in a way, right? Now we have Janet.
That's the point.
You know, we have Janet Yellen being the former Fed head now as a head of the Treasury. We have possibly Brainard, the next head of the Fed. Maybe.
Yeah, but she's really drunk the jungle juice of this administration. I mean, she is full on. She is full on this sort of social wokeness. This, as I said, laudable as it is from a social perspective, it has a market consequence if you are really going to target minority employment, because we know that's the last sector of the economy to get going, and by the time that's happened, your inflation rates picked up. And so I'm very much, Marcus, when I look at this and I look at the 60s, these are the parallels. People forget in the late 60s, the Fed actually did QE. Right, so bond yields, to go back to your real rate thing, bond yields went between 65 and 69 from 4 to 8%, right? So a big rise in nominal. What people don't realize is real fell 250 basis points in a bond bear market. How the hell is that possible? Well, the Fed did what was not called QE then. It was called money debt financing. And the chairman of the Federal Reserve, when faced with this overheating economy, this social agenda and a war of the government, came out and said, to quote the founding, sorry about that.
That's probably Brainard complaining to you. You know, you should stop bashing
exactly.
her. You know, it's like, hello, Brainard here, yes.
Yeah, exactly. Came out and said that the Fed is independent within government, but it is not independent of government. So in other words, if government has this big agenda, it is not for us to fight it. And they basically join forces with government to support the war, to support the fiscal spending. That way they support the real economy, aka the equity market. They subsidize the bond market. What was the end result? It took time because we were in a fixed exchange rate mechanism, but eventually the dollar gets kicked out of the mechanism, and it collapses not just a little bit, Marcus, right? 50%. I mean, you and I are old enough to remember this thing called dollar mark, right? And dollar yen, you know, still exists. But both the Deutsche Mark and the yen rose 50%.
You know, it's interesting because, you know, as I usually do, I prepare my interviews, and I was reading your research, and I was reading about your views on the US dollar, and I had to sit back and be like, no, so I know Julian for quite a while. He's not a perma bear. He's not a person that takes extreme positions to certain things. So it's a really interesting perspective, and I think just maybe also to explain it to the audience, and you understand German, correct me if I'm wrong. Also im Prinzip gibt es zwei Möglichkeiten. Die eine Möglichkeit ist für die amerikanische Notenbank quasi die Zinsen anzuheben, um das langlaufende Ende der Anleihen wegen der langlaufenden Anleihen als Gegengewicht. Wenn sie die Zinsen anhebt, geht der Dollar hoch, ja, der Aktienmarkt geht runter und Biden steht unter Beschuss. Jetzt gibt es aber noch die zweite Alternative. Ganz ungeachtet der Wirtschaftsdaten, nehmen wir an, die Wirtschaft läuft weiter, wie Julian sagt, bis 2022, 2022, 2023, läuft auf allen Zylindern. Ungeachtet der Wirtschaftsdaten behält die amerikanische Notenbank die aggressive Zinspolitik bei. Dann gibt es nur ein Ventil und das ist in dem Fall der US-Dollar und würde in dem Fall zu einem deutlichen Abverkauf führen. Natürlich gibt es da auch eine gewisse Ironie, denn wenn der Dollar abverkauft, ist das in Folge natürlich auch wieder inflationstreibend in den USA. So I mean, they're really stuck in a very, I got to tell you, I was sitting there yesterday reading your research reports, and obviously, you're not the only person I'm reading and I'm studying. But I think one thing that a retail investor really needs to understand is that even though the market is, the stock market is going up, it might continue going up, it is very important to understand what extremely tricky situation we are in and how high the risk is. The example with the clutches, I think, is a great example because the risk of error is pretty big, I would think, right?
Yeah, I totally think. I mean, there's a risk that you don't get the clutch balance right, and it reminds me of my first driving lesson when I was doing a hill start and I virtually couldn't get it right and I almost rolled into the back of the car or the front of the car behind me. And I got so frustrated, I put the handbrake on and got out of the car and walked home.
Julian, I thought you would say you got out of the car and applied for a visa for the United States because nobody drives stick shift.
Exactly. Or that you press the accelerator too far and you slam into the car in front of you, right? So I think we're at this very difficult point, and I think when we connect the dots, Marcus, it's the latter. It's not that the Fed finds it gets aggressive. I mean, I think it's possible that they try, and that you do get some sort of taper thing where they try and get a little aggressive, and the market wobbles on them, but they'll very, very quickly reverse. I mean, the problem that you've got in the United States is that the interconnection, this financialization of the real economy, is a real thing. I mean, if you want to laugh, it's not really a laugh, it's one of those sort of Schadenfreude sort of laughs, is when you go and look at the correlation between total non-farm payroll, and you can pull this up on your screens, and the NYSE, the broad US equity market. And you will see that they are one in the same. And that total employment basically follows the equity market and has done for decades, but the correlations are just so high. So the minute that the equity market goes down, CEOs, particularly in the United States, where there's no, that sort of cradle to grave sort of, employment protection you get, say, in Germany or Japan, look around and go, right, my stock price is down, how do I get it up? Right, cut costs, let me get the chainsaw out. And they just fire, X percentage of the workforce. And so you're caught in this situation where you have to keep the game going, where you have to keep this market going up. Sideways isn't enough, Marcus, right? Because you then get zero employment growth, right? Now you might get it at high levels and you go, well, I don't need any more employment growth, but we know that that's not how a stable place to be. That's not market. Markets trade momentum, not level, right? So they're very, very much caught, and I think we could have a wobble in risk, but to me, they were just going to have to keep this game of subsidizing this bond market, because these deficit numbers, particularly as we get into the second half of the year, the difference between issuance and what is being bought in QE will just build and build and build. Same into 2022. The natural inclination will be for rates to rise. As rates rise, it's going to put pressure on that tech sector, okay, which will put pressure on the relative US equity market, okay, and that I think will come to a point where something breaks. Maybe you get a little wobble, okay, but then they will have to come back in and increase the size of the QE again. I mean, one of my clients believes that to stabilize the bond market going forward, we're going to need $300 billion a month of QE. And in that scenario where essentially the Fed is supporting the equity market, subsidizing the bond market, just like they did in the late 60s, and you run this very loose fiscal, very loose monetary policy, the only way, and you go back and look at in time, people say, oh, well, look, you know, you're running all this loose fiscal, it's tremendously bullish for the US economy, I want to be long dollars. No. Loose fiscal, tight monetary is very good for the dollar. Think Volcker Reagan, right? You know, super tough central banker, you know, government spending money on Star Wars and all that sort of stuff, right? Crushing the USSR, right? Only you and I remember, old enough probably to remember that there was a thing called the USSR, right? That's very bullish for the dollar, but loose fiscal, loose monetary is incredibly bearish for the
and
dollar.
Far looser than the European Union, one might add, right?
Correct, right? I mean, you guys, particularly sitting in Germany, are not going to allow the ECB to become some sort of new age, caftan-wearing, woke central bank, right? Your traditional, so not even the Bank of England's going there.
Keeping time in mind, and I want to go to audience questions in a second. I have a couple of questions for you, but if you could keep the answers short, that would be great.
Yeah, absolutely.
So first of all, I think I would still like to answer the question of the transitory inflation, and I want to stay here briefly because we talked about it quite extensively. So there are certain aspects of inflation that are indeed transitory, right? Look at commodity prices, even though, of course, you know, with the whole green movement and e-mobility, the demand for commodities will probably stay quite high for a while. But China is trying to stabilize commodities. You know, credit growth in China has come down quite a bit. We see commodity pricing coming down a bit also, at least for the last 7-8 trading days. So two questions for me in this regard, and it's also a question that came up here in the audience. Let me just get this up here. Now, where do I have it? In any case, I'll just talk about what he said. So the question for me is this, have we seen already the height of the commodity price boom? Do you think it will continue? And, you know, I was laughing last week, so if you look at Google search, there are two topics that everybody search most, right? Number one is commodities, right? Yep. And number two is cryptocurrencies.
Okay.
That's the number two most searched topic. But let's stick with commodities. Do you think prices will come down, and do you think the sector ran too far?
Yeah, I mean, I think, you know, I look at some of this stuff, and you know, God, these are just enormous movements, Marcus. Right? I think this is testimony to how small on a relative basis these commodity markets have become. Right? You just can't sell 10% of your apple and go and buy, you know, copper, right, without pushing the thing out of whack. So I think, look, some of these things look a little far. Certainly, some of what I would call the more basy industrial, agricultural commodities. So yes, as I said to you, we see this peak in inflation, and part of that is a slowing of the rate of change of commodity prices. Right now, it doesn't mean that they fall a ton, because some of the things that we are going to demand, I mean, you literally cannot. There won't be enough copper around to do all these things. So it doesn't mean it has to collapse, but I do think there's froth there. Don't get me wrong, and that's part of this idea that we've got this peaking of the headline inflation rates. Beyond that, though, when you look at some of the supply issues in down the pipeline, some of these things can be addressed, right? 6 to 9 months, you can address some of the issues, but that's a long time for markets, right? I know policymakers may think 6 to 9 months of highish kind of base inflation is acceptable. I'm not sure that markets will. And there's just other things coming in the inflation side, which I think are a lot more sticky than people realize.
I want to get to that, but let me ask you the question. So Macrobond and Nordea, I'm sure you follow Nordea also.
Yeah.
I love their research. And they're
no, my old buddy used to run it. Jonas Tulin.
Great research, and they're basically saying, look, we might get headline inflation for the May data that will be released at the beginning of June of up to 8%.
Yeah, I mean, it's going to be a startling number.
It would be startling, but and there I think it gets a bit tricky, right? Because yes, it might be transitory, but I think there's no way if we get an 8% number, the market is going to sit back and say like, well, it's just transitory, don't worry about it.
Well, I think, look, I mean, as I said, we've just putting out a piece today where we're talking about this shifting of the debate on inflation from this kind of peak pulse to this transitory thing. And when I look at the transitory thing, there's going to look like there's a window where it's right? I mean, you won't stay at 8, you'll go, or 6, you'll go from, 8 to 7 to 6 to 5 to 4, right? But then what's going on under the surface? So core is going to be rising. We could see core PCE, which is the Fed's favorite metric, hitting 2.5%, and that will happen even as that headline starts to come down. And then you look at some of the other factors. So owner equivalent rent, so the kind of how the Fed calculates housing costs, tends to follow house prices. I mean, it's a pretty bullshit way of measuring it, to be brutally honest. It's a way of suppressing, I think, like a whole bunch of stuff that these central banks have done over the years, of suppressing really what's going on in terms of cost. But it tends to follow house prices. And it could easily run up from 2 to 4 next year, right? And that will help to support. You've got some issues in the supply chains, which is just not going to get fixed, right? Some of these semiconductor problems are not going to get fixed because there are bottlenecks in the supply chains where you have oligopolistic pricing of companies who control these bottlenecks, and they're not going to increase capacity markets. They're just going to take greater price increases. Same in lumber, right?
What about wage growth? I mean, you see McDonald's is raising wages, Bank of America.
So wage growth to me, wages tend to be sticky downwards, right? To use that expression. So they rise and then they don't fall quite as fluidly, right? They're sticky. And there's no question that we have accelerative wage growth because of all these various other metrics, right, going on. And our model looks nothing like 0809. In 0809, we went from sort of 3.5%, 4% wage growth right down to 1.5%. In this one, we are sticking. Our starting point is 3, and this is kind of, if you go back and look at those late 60s, what we call this oscillation of inflation. You go from 1.5 to 3.5. You hit it, we go down to 2.5, but we don't go back to 1.5, and then we go from 2.5 to 6, and then you hit it, and then we go down to 4, and then we go down up to 8. It's this building oscillative cycle.
So, many in the audience, or at least I get those comments quite a bit, is like, well, wage growth is fantastic. Why shouldn't we celebrate wage growth? People have more money to spend. It should be wonderful. But I think that we need to differentiate between what wage growth means for the individual and what wage growth means for profit margins of companies and for the stock market, right? Correct.
And I think, as I said, it's highly laudable that we are trying to address inequality. For Christ's sake, in the United States, we've got, wealth discrepancies that are greater than Louis XV, right? I mean, do we really want to be chopping, Jeff Bezos' head off because everyone else is living in a ghetto, right? The answer is no, right? So addressing those things are absolutely desirable, but it has a market consequence.
I want to touch on 2 topics, and and I would like to ask you for brief answers. You are gold bullish. You used to trade precious metals also at one of the big trading desks.
Yeah.
What's your take on precious metals and gold? And in that connection, and I know that a lot of my audience is probably going to now go apeshit and be like, well, you can't put cryptocurrencies and gold in the same thing. It's two totally different worlds. Yeah. But what's your take on gold and gold miners? And then the second question, what's your take on the cryptocurrency environment?
Right. So we've been bullish on precious metals. I mean, the first trade I think we did actually in March of last year. We bought silver at like 12.40 or something, ran it up to like 26, 27. Really like, and did the same with gold and gold miners, and we just got back into kind of all of those trades. Like the price action, I think the suppression of yields is actually quite important for gold, nominal, not just real. And so this sort of interregnum here where we got that bond yields are not spiking is actually quite positive for gold. So we're long both of those. We like it. I like it. I like the gold miners story. I'm sure you follow the guys at Crescat. They've done some amazing work on gold mining. I know them personally. They're in Denver, just down the road. We met and had beers together. I think, they're extraordinarily good at making money out of this sort of thing. So I like this thing if I'm bearish on the dollar, which I am, because, we may have to go through wobbles and whatever to get to that point, Marcus. But as I said, when I connect all the dots, I don't see any other way that when we look at that impossible trinity of rates, equities and the dollar, that it's not the dollar that ends up ultimately taking the strain.
I'm going to interrupt you before you go into the whole cryptocurrency world, because I want to integrate two charts that you have on your Twitter account. And by the way, guys, you can find Julian on Twitter. Wonderful to follow, and you've already seen in the last couple of months quite a few charts that he uses in my stream. So let's look at not a cryptocurrency, but a Tesla, which you called really well.
Thank you.
You warned of this being a bear trap, and now basically, getting to the cryptocurrencies, you now see a chart that Julian posted. I think it was about when the whole crypto environment melted down. Looking at Ethereum, and yes, Ethereum did recover quite a bit, but this too looks very much like a bull trap. Correct. Is that still your opinion?
Yeah, I mean, look, Tesla, I think, is emblematic of this sort of excess that went into the tech sector. In fact, really, if you look at the whole momentum play, most of these FANG names kind of gone nowhere since September, Marcus, right? And so that whole momentum space was really predicated on Tesla going from sort of 400 to 900. That's what kept that whole space going. But unfortunately, it created a classic bubble. And this is just a chart structure that we've used at MI2, been going a while now, 10 years. We've used time and time again, and it works on, 1929, Nikkei in 1980, Microsoft in 2000, blah, 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 blah. So you have this parabolic move, you then have this sort of blow off top. That's where the ultimate greed comes in. You build up all these positions at bad levels. You then start to you run out of oxygen, essentially, Marcus, right? You can't push any higher, and you start to drop, and then you move into this fear where it's not about fundamentals. And in a way, the up move, the parabolic move wasn't about fundamentals. How the hell can you take Tesla from 450 in November to 900 in January and argue that that was a fundamental move, right? There's nothing fundamental about it. It's all about greed and momentum. And then you lose that momentum and you move into fear. And we think ultimately this is that yellow trend line that you showed that came in. Tesla held it very, very well, but I think it'll probably end up breaking that. And ultimately, I can see Tesla falling to about $200, maybe 275. But it's a bust bubble to me. And when you look at Ethereum has a very similar pattern. So we're trying to build a base, and we've done quite nicely. And the levels that I've been watching are the sort of 3,000 level, and then that next, what I call the possible neckline. And then you follow that green line, you sort of bounce, you suck everyone back in, and they go, oh, here we go, right? And it fails. Now, I'll be wrong if you go through that kind of neckline and through to a new high, but I worry about these trapped positions now. And I look at, you mentioned it before the interview, that the sort of comments of central bankers. I think the one that we really have to watch are the Chinese, not the Fed. The Chinese, I think, are much, much more serious about clamping down on these private sector coins ahead of the launch of the digital renminbi, right? I would not be surprised to see, unfortunately, either a couple of big Chinese traders or miners having to hand over their dollar to get the bullet that shoots them through the forehead, to be picked up as an example of what you're not supposed to do. And I think there's more coming in terms of that clampdown in that space. But I think they're deadly serious. I don't see why a central bank, particularly someone like the Chinese, but even the Fed or the Bank of England or whatever, would sanction. And this is the problem I've always had. It's not a great trade. It's been an amazing trade. Raul's made an enormous amount of money out of it, right? And all the people in the crypto space. I've met guys who've made multi-millions, young guys, right? Great trading. But I think there's a naivety there about does the system, this current fiat system of central banks and governments able to print money, ultimately want to create a get-out-of-jail-free card for private investors? And the answer is no. There's no incentive to allow them to lose their ability to have seigniorage, to lose their ability to force financial repression onto people, right? And so I've always said, when it becomes a big enough thing, that's when you have to actually get very, very worried that it challenges the system. What I didn't see, I've always thought that would be kind of the Fed, or, you know, when we get inflation and the dollar's under a lot of pressure. But this Chinese thing to push the digital renminbi, I think is going to be the real first test.
I mean, I think it's, you know, the whole, also keeping in mind that the Federal Reserve, together with MIT, is working on their own digital currency experiments. And I think
they're way behind the Chinese, right?
They're way behind, as they are in many aspects of technology. I mean, just look at WeChat, for example, you know.
Yeah.
But you know, it's going to be interesting to see. I mean, when you have somebody like Brainard or Bullard coming out and saying that you don't want to have a fragmentation of the payment system,
right?
That, you know, I know that a lot of the crypto world are dismissing these comments, but, you know, having worked on Wall Street for 30 years and also being on the trading desk in the early 90s myself, I don't think you should ignore comments from the central banks, you know, in that regard.
I think, you know, when you're essentially taking on the system, which is what crypto is, it's a really aggressive stance. I mean, I remember, you know, this is a great little anecdote. When I worked at Medley Advisors, which is a policy group that I worked for a while, we were talking about the trial of Jeff Skilling from the Enron executive. Mm-hmm. We were talking to a Texas senator. And you'll love this one, Marcus, because you've lived in the States. And we were talking about, you know, does he go down? What happens? You know, et cetera, et cetera. And the Texas senator said, look, I don't really care what happens to this boy. I just want him to end up in a big dark hole with a boy called Bubba who calls him Shirley. Okay? And I just thought, to me, that was just one of those things that just sticks in your mind. And it just tells you, be very careful to take on the system. Right? Be very careful to take on the system, because the system is very, very powerful. At the depths of the financial crisis, the number one issue in the National Threat Assessment in February of 2009, so in other words, all the security services, NSA, FBI, CIA, whatever, the number one threat was the economy. And from that point, you saw positive stories in the newspapers, positive this, price action. Look, these are very, very powerful systems with massively invested interests. And I'm afraid when the threat, and even more so in China, and so if the Chinese have made their mind up that they don't want the private sector challenging the potential gains that they could come from the digital renminbi, what makes you think from a moment that they won't line up a bunch of miners and speculators, take their dollar, and you just see them going bang, 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 bang? And then do you want to be that guy that says, you know, that's going into the hole with the boy called Bubba who calls you Shirley, right? Do you want to take that risk and say, I know this is decentralized, you'll never be able to find my money, right? I'm just going to keep playing here. Do you really want to be taking that? I'm not sure most people do.
You're going to make me you're going to force me to explain in German now what that example means, and I'm not. I'm just telling you right now, I'm not going to go there. All right. So let's take a few questions. I mean, we've taken a lot more time than we were originally planning, and I really thank you for your time. I know markets are open. You have, you know, also other things to do. So the question here is regarding the whole renewable energy sector. You know, the green energy sector. We now have. And I think it's actually, in my opinion, mostly media headlines about, you know, the big budget plans for 2022, $6 trillion. You know, I think that most of this stuff will never happen to this extent. But what's your take on renewable energy and that sector?
So look, we're very bullish on the space. We wrote something about hydrogen. We like that space. So I think there's some great plays to be had in some sort of diverse places. Japan is a place to watch very, very closely. Some fantastic companies in Japan are in that space. I think it will take time I love the trade that Raoul put out about these EU carbon credits. I think there's a bunch of activity going on in that space that I think is happening. Look, if you want to be a cynic, Marcus, right? If you want to say we needed an excuse to right the wealth discrepancies in society, we needed a war to fight, right? The Second World War, the new Vietnam War, then picking a war on climate, which gives government an excuse to spend money on greening the economies, is as good as one as any. You can get most people behind it, right? If you want to be a true cynic. And so why fight this trend, right? It can get over frothy, like, as I said, you know, copper and some things look very over frothy. But on a dip, you buy these things because this is a trend that's set for a long, long time. So.
Yeah, I mean, it's like, I know the example, you know, doesn't really fit here, but look at the SPAC boom, right? I mean, I got the craziest calls, you know, do you want to interview the CEO of the SPAC going public? And I said, look, there's no such thing as a free lunch on Wall Street. You have all these SPACs going public because 70% are being bought up by retail investors that don't really understand how much money Wall Street is making with these SPACs. But that, I mean, it's incredible, but that's a different topic. So let's, one more question from the audience going back to silver. Do you have a specific target for silver and why?
So look, I mean, we've said this to clients, and this is what we put out in the research. The initial target would be 40. The big target, there's like a double top on the charts, as you can say, that goes years and years and years back, is 50. And it's predicated a lot. I mean, you know, I will be wrong on the inflation story in 2022 if we have a strong dollar. I'll be wrong on silver if you have a super strong dollar. I just don't see how we get out of this thing when you connect the dots that you can have a strong dollar, though, ultimately. So that's, I think eventually you can go through potentially 50 if my worst case scenario on the dollar is right.
Let's take the last question from wonderful name and great thumbnail, the reverse repo daily records. What's happening over there?
Look, I mean, you've got all sorts. I mean, there's just too much cash at the front end of the curve, right? I mean, there's just too much cash sloshing around in the system, and there you can see that you've got stress in how they sort of manage this. I mean, I really don't think it's that big of a deal structurally. I think we've kind of addressed that. They didn't see it when we had the repo problems a few years ago. I think they have, but it does encourage markets to rise. I mean, we saw, you know, if you want to go back to 2000, the icing on the cake, the thing that drove the NASDAQ up 100% from the day it was launched were those Y2K funding facilities, right? And I know you'd go to the Fed. I was working at this consulting group, and I said to one of the guys who talked to the Fed, I said, go and tell them this, right? Show them this chart. You launched these Y2K funding facilities, and the NASDAQ, which was up 100% year to date at that point already, just goes parabolic, right? And I remember seeing a client who had worked at Tudor at the time, and apparently Paul Tudor Jones came over the internal hoot and said to all the traders, they've given us the money, start buying shit, right? And I think, you know, this game where we just create this money, Marcus, I mean, it has a consequence. It goes somewhere. So I don't see it as so much of a structural problem. It's just another thing that's feeding this current kind of euphoria.
It's interesting. I had an interview yesterday with a bigger German fund manager, and he basically said the same thing. Julian, I could talk with you endlessly, and you know, it was great practicing my English with you. And my audience is like, dude, translate. What the heck? You know, I don't understand everything. The next time. Weil du in Reutlingen studiert hast, sollten wir die gesamte Schaltung dann auch, ne? und zwar in dem Dialekt von Reutlingen sollten wir...
Ja, genau, ja. Ne? Schaffe, Hausli, Bauer.
Genau, ja. Aber das hast du ja gut gemacht. Du bist in Vale, Colorado und ich bin in New Jersey, beziehungsweise hier in New York City, ja?
Ja.
Julian, I really appreciate your time. Thank you so much. It was a real honor having you here. And one of the many things that I always appreciate about you is that there is a certain lack of panic when you explain stuff. You know, very often, and especially in the financial media, there's a certain sense of urgency and panic and need to do something urgently. And you have a great way of looking at the market. And you know, now the only thing I would ask you for, I need a discount to subscribe to your research, but we'll talk about that afterwards.
Exactly.
And I hope to see you at RealVision again. It's a great way to watch him. Also wenn man mehr von Julian sehen will, gerne auch bei RealVision. Findet ihr auch im Übrigen auf YouTube, ein großer Kanal dort. Und alles sehr empfehlenswert, sehr in die Tiefe gehen. Julian, thank you so much. Und jetzt kommt dann auch gleich der Risikohinweis. You know, we have to do that in Germany too.
I get it.
Der Risiko, but we did it a little bit different than usual, der Risikohinweis. And I'll thank you very much und vielen Dank euch fürs Zuhören. Ich weiß, das ist heute eine große Herausforderung gewesen mit der Sprache und zwischendurch zu übersetzen. Da sagt die eine Hälfte der Community, don't do it, wir verstehen Englisch, die andere Hälfte sagt, übersetzt doch mal. Also ich habe mich heute mal für die rein englische Variante entschieden. Ich wünsche euch einen schönen Abend. Viele Grüße nach Vail, Colorado, viele Grüße zu euch nach Europa und bis bald. Ciao.
Ciao. Thanks, Marcus. That was awesome.
Thank you so much. 1 second.
Okay.
Und jetzt der obligatorische und BaFin-sichere Risikohinweis von Mr. Markus Koch.
Meine Damen und Herren, liebe Aufsichtsbehörden, ich darf Sie darauf hinweisen, dass die Inhalte in diesem Video ausschließlich der allgemeinen Information dienen und keine Empfehlungen zum Erwerb oder der Veräußerung bestimmter Finanzinstrumente und somit keine Anlageberatung darstellen. Insbesondere können Wall Street Correspondents und der Vortragende, das ist dieser Mann hier, nicht einschätzen, inwiefern die im Video gemachten Empfehlungen ihren Anlagezielen, ihrer Risikobereitschaft und Verlusttragfähigkeit entsprechen. Wer also auf Basis von Informationen in diesem Video etwaige Anlageentscheidungen trifft, trifft diese ausschließlich auf eigene Verantwortung und eigene Gefahr. Und das wiederum bedeutet, dass weder Wall Street Correspondent noch der Vortragende, das ist immer noch dieser Mann hier, für Verluste haften, die sie dadurch erleiden, dass sie Anlageentscheidungen aufgrund von Informationen oder Kommentaren in diesem Video getroffen haben. Vielen Dank für die Aufmerksamkeit und weiterhin einen erfolgreichen Handelstag.